Not every major crisis begins with noise. Some begin quietly. They move slowly. They grow unnoticed. While people continue their daily lives, while shopping, while making plans for the future, small decisions accumulate in the background. One loan is issued, then another, then thousands more. Each one makes sense on its own. Each one is part of the system. But no one asks this question out loud. What if things don't go as planned? That question is exactly what we're answering today. This video doesn't just tell the story of an economic crisis. This video explains how the modern financial system works and how it can break. The Great Recession is defined as a period in which the global economy slowed simultaneously and the financial system was severely shaken. But that definition isn't enough, because what happened during this period was not just a slowdown in growth. Trust was shaken. Expectations collapsed. People began to hesitate when looking toward the future. At the core of the financial system lies an assumption that everything is under control. The Great Recession showed just how fragile that assumption really was. It all began in the housing market. For most people, a home is not just an investment. It represents security, stability, the future. As housing prices rose, that sense of trust grew stronger. Banks issued loans. People bought homes. The market expanded. But this growth was built on the assumption that everyone would continue making payments at the same time. When that assumption broke, it wasn't just the housing market that was shaken, but everything connected to it. The credit system is the bloodline of the economy, but credit is also a promise to pay in the future. Some of the loans issued during this period were designed with too much confidence in that future. Payment terms were complex, interest rates were variable, risks were postponed. The problem wasn't a single loan. The problem was that these loans became systemic. When one person couldn't make a payment, it wasn't just their problem, it was the first link in the chain. Banks grouped the loans they issued and turned them into financial products. The goal was simple: to spread risk. But in practice, something else happened. The risk didn't disappear, it became invisible. These products were perceived as safe, poorly understood due to their complexity, spread across global markets. At a certain point, no one could clearly say who is actually holding this risk, and uncertainty is the greatest enemy of a financial system. As uncertainty grew, banks began avoiding lending to one another because trust was gone. Credit flow slowed, then it stopped. This moment marked the turning point of the crisis, because the modern economy depends on credit to keep moving. When credit stops, the system can't breathe. The problems in the financial system quickly spilled into real life. Layoffs began. Incomes declined. Consumption dropped. At this point, the crisis was no longer an abstract concept. It became a reality that directly affected people's lives. To prevent an even greater collapse, central banks and governments stepped in. The goal was not to blame the system, but to keep it standing. Interest rates were lowered. Liquidity was provided. Trust was slowly rebuilt. Thanks to these steps, the economy gradually stabilized. The Great Recession taught us something important. Risk grows when it is ignored. Trust, once lost, is difficult to restore. And the economy is not just about numbers. Many of the economic decisions made today are based on lessons learned from that period. Because this crisis is not just an event of the past, it is a reminder of the fragility of the modern world. This video was created for those who want to understand how the economy really works behind the scenes. If this story gave you a new perspective, don't forget to subscribe and share the video. In the next file, we'll explore the hidden sides of money and the system together. This is the Money Files.